Can you hear me in cyberspace?
Now we can, yes.
Yes, I can hear.
Can you hear me in cyberspace?
Yes.
I can hear you. This is Valerie.
Well, I guess we can get started then. The screen still isn't showing quite what it should show. So let's see if we can free this out here. Something wrong with the screen here. There's supposed to be something in the upper right corner, but there isn't. Okay, well, let's get started. Everybody can hear me. Hopefully you can see the PowerPoints as well. Maybe I should ask that as well. Can you see the PowerPoints?
Yes, we see the PowerPoint.
Okay, good. Okay, this chapter, I should mention, I've been sending out some announcements and things. A few of you have asked for additional quizzes, so I posted some additional quizzes. Some wanted them for extra practice opportunities, some wanted them because your internet was cut off, because of the storm and so forth. So anyway, you have a few extra quizzes there. If you take them and you get low grades, don't worry about it, as long as you have at least one grade that's higher, because I'm taking the highest grade from each chapter. So, if you want extra learning opportunities, go ahead and take those quizzes. Nothing to lose, really, and maybe something to gain if you get a higher grade. I noticed some of you, if you got 100 on the first one, you didn't take anything else. That's fine if you want to do that, but you're depriving yourself of extra learning opportunities. But if you get 100, maybe you don't need any more learning opportunities. I don't know.
But I was saying, like, before you allowed us to see the answers on them, I was saving one from each chapter so I could practice for the exam for refresher.
Oh.
So it's not that I didn't want the opportunity, I just was like, I really could appreciate this Richard for the test. But now that we can see them, that helps. So.
Oh, good. Okay. Yeah. Yeah, I've been getting good feedback from that. So we'll see. And it's algorithmic, which is a fancy way of saying everybody gets a different question with different numbers on it. So, you know, even if you sold them to people, there'd be different numbers. So, you know, and they get different questions too, because I hit this little button that says mix it up kind of thing. And so, yeah. So you can get the answers sooner instead of never. And I think the ones I posted this afternoon, you get the answers immediately. You don't even have to wait until after the due date. So, no.
I just took one and didn't do that. It was as far as tonight. And looked at the nine, so that's when the thing you see it. So I went back into it. It didn't show.
Oh.
Yeah, no.
Oh, okay. Yeah, at some point it's supposed to show you the answers.
Maybe the next one.
The ones I did, the last group that I posted today, it's supposed to show them immediately as soon as you're done.
Chapter 5. That's what
4, 3, and 2.
Oh, the extra ones.
Yeah, the extra ones. I did chapters 4, 3, and 2 extra.
I took, I think it's for chapter 4. I think you got 4 of them. Yeah, a couple extra. I did see a couple.
Yeah.
Nevertheless, you're good.
Yeah. Okay. Good.
Yeah.
Okay. Well, let's take a look at the contents of this chapter. Management accounting is all about contribution margins, break-even points, profit margins, things like that. But we do refer to the financial accounting rules from time to time. Absorption costing is the method we use for our financial statements, what we show to external readers, people who are not employees of the company. We use variable costing a lot of times to figure out things like break-even points and profit margins. So there are some differences. Sometimes we classify some things as period cost, or other times they're product cost. And this slide sort of sets it out for you. Under variable costing, the product cost consists of direct materials, direct labor, and only the variable portion of manufacturing overhead. Period cost, again, those are costs that are deducted at the end of the period, would include the fixed manufacturing overhead, variable selling and administrative expenses, and the fixed selling and administrative expenses. So one question that you run into on these quizzes and maybe on the exam is what happens if the inventory goes up during the period? Will the bottom line or operating income, net income, will it be higher or lower under, let's say, absorption costing? If inventory goes up during the period?
If inventory increases?
Yeah, if inventory increases during the period? Yeah, if inventory goes up, that means there's less cost of goods sold, right?
Oh, yeah.
Yeah, if there's less cost of goods sold, because remember, cost of goods sold is beginning inventory plus purchases minus ending inventory. If ending inventory is higher than beginning inventory, you're going to subtract more, which means cost of goods sold is going to be less. If cost of goods sold is less, the bottom line is going to be higher. So that might be one way to sort of think that through. And again, the only difference, what is the only difference? Between absorption costing and variable costing, there's only one difference. What's the difference? Yeah, the fixed portion of manufacturing overhead. All right, yeah, it's a period cost under absorption costing. Or, no, let's see, I'm getting mixed up myself here. Yeah, it's a period cost under absorption costing, and it's a product cost under variable. I shouldn't get mixed up anymore. Nah, sure I should.
Say one more, because I don't think you said it.
Didn't I? Let's see. Now, yeah, for variable costing, let's see. I'm getting all mixed up myself now. Yeah. The fixed part. Let's say like rent on the building and so forth. The whole thing. Yeah, that becomes a product cost under variable. That's right. Product cost under variable, but period cost under absorption. Got it. Okay. Thank you for explaining that to me. Okay, again, there we go. when I push the arrows. Sometimes they work, sometimes they don't. Under super variable costing, this is in the appendix. We're probably not going to do anything out of the appendix, but it's worth noting anyway, just so that you know that there's that the way we're talking about in Chapter 5 isn't the only way you can look at things. What's the difference between variable costing and super variable costing? Well, if you'll notice, under product costs, for super variable costing, product costs consist of direct materials, direct labor, variable manufacturing overhead, and the fixed manufacturing overhead. The period costs consist of variable selling and administrative, and the fixed selling and administrative. And what other difference is there? Remember I said before that in some countries, and I mentioned Japan as one possibility, direct costs are considered as fixed instead of variable. Remember I said that? Maybe the first week, second week in class, somewhere in there. And if you were to make that argument that direct labor really should be a fixed cost instead of variable, what argument would you make? Yeah. If direct labor should be fixed instead of variable, why should it be fixed instead of variable?
Because it's not. If you hire a set of people for a week, this for a week is not the amount that they produce for that week.
Yeah, unless they're assembly workers where you pay them 50 cents a unit or $2 a unit or whatever it is, you're going to pay them a certain amount every week. So much per hour, so much per week, so much per year, regardless of production. That starts to sound like a fixed cost, doesn't it? Yeah, for purposes of these textbooks in the United States, we treat direct labor as variable because it makes things easier. But sometimes direct labor is variable and sometimes it's fixed. It depends on the nature of the labor. You know, if they're assembly line workers and they don't get a salary, they get paid based on how many units they assemble, or in agriculture, based on how many crates of cherries or peaches you pick, something like that, then that would be a variable cost. If they're just salaried workers, then it's fixed. But if they get a base salary plus 10% commission, then it's semi-fixed, semi-variable. But then they're sales staff, and it's not a product cost anyway, right? Okay, I just thought I'd mention that. I hope that clarifies things. Which method will produce the highest values for work in process and finished goods inventory? Absorption costing, variable costing. They produce the same values for these inventories, or the ultimate answer in accounting, it depends. It depends. That's the authors. That's the answer the authors want you to choose. Well, think about it. To produce the highest values for work in process and finished goods inventories. In other words, stuff that you're building into inventory that you haven't sold yet. In other words, which...
Inventories increase, CNOI increases.
Yeah, you're building those costs into the inventories under which assumption? Yeah, because absorption includes both fixed and variable overhead. And so you're building more cost into absorption because it's both fixed and variable, not just variable. Yes? Is that a trick question?
Yeah.
Well, yeah, if it fooled you, it's a trick question.
Out of page depends.
And depends, that's usually the answer, is it depends. But in this case, it's not. It's absorption costing. The reason it's absorption costing is under absorption costing, you're including both the fixed and variable components of manufacturing overhead into the inventory. So the inventory figures will be higher because you're including 4 things instead of 3. Direct material, direct labor, and both the fixed and variable portion of overhead, factory overhead that is. How many kinds of overhead are there? How many?
Times 30.
3, exactly. Manufacturing overhead, administrative overhead, and selling overhead. Yeah. Which ones are period costs? Administrative and selling are period costs. No.
Well,
Okay.
I was wondering that in the book, in the very beginning of the chapter, it said administrative and selling costs are never going to be absorption or variable. Why is that? Is it because you don't know in that period how much it's going to cost to sell something?
Well, the selling overhead and administrative overhead could be fixed or variable, but they're never a product cost because they're not part of the manufacturing process.
But you still have to pay.
Yeah, you still have to pay, but they'll never be a product cost.
I guess I still know why they determined that something like a variable, some of the variables would be part of the product cost, but not the cost to sell it.
Well, for manufacturing overhead, that could be fixed or variable, and that would be a product cost. Administrative or selling overhead can be fixed or variable, but that's a period cost, deduct at the end of the period. I don't know if that answers your question.
I mean, I get that that's the rule. I guess I just don't care. That's my thing.
Oh, okay. Well, because you separate the costs into their various components, you have the manufacturing operation, the selling operation, and the administrative part of it. And selling has nothing to do with manufacturing. Administrative has nothing to do with manufacturing, unless it's administration within the factory. And then it would be part of producing whatever product it is that you have. So,
I
yes?
have a question. Someone is trying to log on online.
Oh.
Yeah, she needs the access code in order for her to join us. Do you?
And how did you know that? You have secret information here? What's going on? Is this direct from Langley or what? Manage participants, find participants. Okay, so who's unmute all? The access code that we're using all semester, can you transfer this? 313 626 7490. Yeah.
The access code that you have to do.
You're welcome. I wonder why there's stuff on the right side of the screen and it's not appearing today for some reason. So I hope that everybody in cyberspace can hear and see this stuff here. Okay, so what do we have here? Unit cost computations. Now, remember I've been telling you all semester, don't compute fixed unit costs. What do they do in chapter 5? Yeah, they compute them. It's to illustrate, though. It's to just illustrate how things come together, regardless of whether you use absorption or variable costing, as long as certain factors don't shift around and change. Now, the thing is, in some of these examples, they do change, but that's okay because of the way they structured this particular presentation. But in the real world, unless you're trying to reconcile something, don't take fixed cost and divide it by number of units. Because the larger the production is, the lower fixed cost per unit, as we're going to see in some of these slides. But when you're thinking about, what's the break-even point, what's the profit margin, if you're trying to answer those questions and you include a unit fixed cost, it could lead you to the wrong answer. If you're trying to think about, should we increase this or should we get rid of this division or something. So don't do that at home, folks. But you can do it in chapter 5 a few times. And if you don't know what I'm talking about, that's okay. In a few slides, I'll point it out to you. So here we have unit cost computations. Harvey Company produces a single product with the following information available. They produce 25,000 units annually. The variable cost per unit for direct materials, direct labor, and the variable portion of manufacturing overhead is 10. Selling and administrative expenses, the variable cost per unit is 3. $10 is a product cost, $3 is a period cost. Fixed cost per year, they have two kinds. They have manufacturing overhead of 150,000, and they combine the selling and administrative expenses into a single number, 100,000. Did anything just change? I pushed the button and nothing happened. I don't know why. Sometimes I push the button and something happens, and sometimes it doesn't. There we go. The unit product cost is determined as follows. So under absorption costing, you notice how this is structured. Under absorption costing, there's a column, and variable costing, there's a column. For direct materials, direct labor, and variable manufacturing overhead, it's 10, and that's under absorption and variable. But under absorption, you also have fixed manufacturing overhead. And that's $6 a unit. Where does that come from? Let's see if I can back up one slide. You have the manufacturing overhead, $150,000 divided by 25,000 units. Right? $150,000 divided by 25,000 units, that would be 6. Unfortunately, the authors don't show you that, but that's okay. And so the unit product cost under absorption is 16, under variable it's 10. Of course, if the volume goes up or down, if it's 30 or 20 or 15, that unit fixed cost is going to be different. So let's just assume that it's always going to be 25,000 units. Under absorption costing, all production costs, variable and fixed, are included when determining unit product cost.
Where's my pen?
Under variable costing, only the variable production costs are included in product cost. The fixed portion is deducted at the end of the period as a period cost. So we're supposed to prepare income statements using both approaches, variable and absorption. Income statements, again, revenue minus expense, but it's a little more complicated because for variable, you subtract variable expenses and then you get, what do you get? Revenue minus variable is contribution margin, then you subtract fixed to get operating income. Whereas under absorption, you deduct both fixed and variable. Let's assume the following additional information for Harvey. 20,000 units were sold during the year at a price of 30. They produced 25,000 units, but they only sold 20,000. There's 5,000 units in ending inventory.
This water cold, you know. You
So,
wash dishes in cold water.
which income statement would produce the larger operating income? The absorption income statement or the variable income statement?
Absorption, because it's 25,000.
Your voice says absorption, but your eyes are telling me I'm not really sure.
Why aren't you flipping this?
No, that's right. Think about it.
Make
They
it
produce,
warmer.
Because in absorption, right, you said they created 25,000 units and they sold 20,000.
yeah, they made 25,000 units, they sold 20,000. So they have 5,000 left over, and absorption, some of that, 20% of that manufacturing overhead, the fixed portion of manufacturing overhead, is going to be in the inventory, which means it's not going to be included in cost of goods sold. So cost of goods sold would be less, and if you're subtracting less from revenue, it means you have more left,
Oh,
and so, which is what you said. It's just your eyes were telling me I'm not sure, but let's go with this. And so I just thought I'd bust your chops. If you would have worn sunglasses, I would have known. You gave it away. Uh-oh. She's putting on the sunglasses. Uh-oh. Yes? Well, yeah, I can. Now, the bad thing about having this approach is that I can write stuff on the blackboard for you, or as I say in New Jersey, you guys, but the 100 and so students in cyberspace aren't going to see it. But I can. Oh, let's see what happens. They produced 25,000 units, but they only sold 20,000. So 20,000 divided by 25,000 is 80%. Okay? Maybe those in cyberspace can see this because the camera's right here. I'm hoping they can see it. 20,000 units were sold, 25,000 units were produced, and so that's 80%. 80% of the fixed manufacturing overhead is going to go into cost of goods sold, which also means 20% is going into ending inventory. So the difference in operating income is going to be the 20% of fixed overhead that goes into inventory instead of being deducted. Can you see it over here, by the way, or is the screen in the way? Yeah? Okay.
So
Okay.
the original question was which one would have a higher,
Yeah, which would have a higher operating income? Absorption or variable. Yeah, the answer is absorption, because 20% of the fixed manufacturing overhead is going to go into ending inventory. It's not going to reach the bottom line. And again, I hesitate to use the board, but
Because you take 5,000 units and you give up to the next month.
yeah, exactly. The 5,000 units that you don't sell this time, you're going to sell them next time, hopefully. Again, I hope the people in cyberspace can see this, but if they can't, I just drew an equation on the board. BI, beginning inventory, plus P, purchases, minus EI, ending inventory, equals CGS, cost of goods sold. If 20%, it's supposed to be 0, 20% of the fixed manufacturing overhead is in ending inventory, then that means 80% is in cost of goods sold instead of 100%. And so net operating income in this particular case would be higher under absorption costing because you're only deducting 80% of the fixed portion of manufacturing overhead. Now, the next time, if they produce 25,000 units again next year, how many units can they sell if they sell everything? 30, because they're producing 25 in year 2, plus they have 5,000 from last year. And so it's going to reverse in year 2, assuming in year 2 that they sell 30,000. Good, you guys are catching this stuff. I like that. So there's 20,000 units sold during the year. This is year 1. At a price of 30, so 20,000 times 30 would be the revenue, 600,000. There's no beginning inventory, so we don't have to worry about that. Now let's compute the net operating income using both absorption and variable costing. And I don't know why they have that, but there we go. So notice how it's structured. Again, variable costing, sales, 20,000 units at 30, so that's 600,000. Less the variable expenses. The variable manufacturing costs we figured out before were 10. Remember, absorption were 16, but for variable they're 10. So the variable cost of goods sold, 20,000 units at $10, 200,000. Variable selling and administrative, the other $3 per unit times 20,000. So that gives us 260,000. And then whatever's left is the contribution margin. 600,000 minus 260 is 340. And then minus the fixed expenses, 150 and 100. It says all fixed manufacturing overhead is expensed. That's another way of saying it's a period cost. You deduct it at the end of the period. And so the bottom line, net operating income, is 90,000 under variable costing. So what do you think it would be under absorption costing? Higher or lower?
Higher.
Higher, yeah. By how much? 5,000?
5,000 times, because it's
Yeah, 5,000 times 6. 5,000 times 6. Why 6? Because the fixed cost per unit is 6, right? 6 times 5,000, 30,000. Yeah. Again, the 5,000 is the difference between the 25,000 they made and the 20,000 they sold. 5,000 times that extra $6 unit fixed cost is 30,000. So 90,000 plus 30,000 is 120. Are you saying that the next slide is going to say 120?
Yeah.
Yeah, it's better, or else somebody's wrong, and you know who that somebody is. Saved. It's 120, just as you predicted it would be, which is just 16 now instead of 10, $6 extra times that.
And it was the 5,000 times 6.
Yeah, 5,000 times 6 is 30. 90 plus 30 is 120. So we knew in advance this was going to be 120, but if the boss asks you to do this, you would show the full presentation, just so you can see what's going on. So sales, 20,000 at 30, same thing. Cost of goods sold, now we're using absorption costing, so the unit cost is 16 instead of 10, because that other 6 is the fixed portion. That meets the 320, so 600 minus 320 is 280. That's the gross margin, minus the variable cost, 20,000 times 3, and the fixed, and leaving us with 120, which is 30,000 more. Instead of 90, it's 120. The 30,000 would be the 6 times 5,000. And that's what they say here at the bottom of the slide. Questions? You going to remember this tomorrow morning when you get up? This is the kind of stuff that may fade, but eventually you get it. Reconcile variable costs and absorption costs, net operating incomes, and explain the two. We already did that. It's based on that $6 fixed unit cost. But here they have a nice way to present it with arrows and multicolors and all that stuff. So notice how they structured absorption costing on top, variable costing on the bottom. The cost of goods sold, variable manufacturing cost 200,000, fixed 120. So that's 320 versus and the ending inventory also, that 30,000 extra. Yeah, the 50,000 variable manufacturing cost and the fixed. So the 120 plus the 30 is the 150. That would be the period cost. Period costs are deducted at the end of the period. And you notice the period expense here under absorption costing, that's not listed there. So again, the total 400,000, 400,000, 250, 150. But the difference is in the treatment of the fixed manufacturing costs. And again, this represents 80%, right? 80% of 150,000 is 120. 20% of 150,000 is 30. And the total, the sum of those two would be 150. So it's a nice presentation, but we already knew what the answer is going to be because we just thought it through. The only difference is the treatment of that portion of the fixed manufacturing overhead. We can reconcile the difference between absorption and variable income as follows. The variable costing net operating income was 90, and then we add back the fixed portion of manufacturing cost that was included in the ending inventory because they made 25,000 units, they only sold 20,000, so there's 5,000 unsold units at a fixed unit cost of $6. So 5,000 times 6 is 30, and then you would add that. Why would you add it instead of subtract it? Why would you add that 30,000 instead of subtract it? Yes?
Is it because it was sold on that year?
The ending inventory was higher than the beginning inventory. Beginning inventory was 0. The ending inventory was 30, and so it went up. That means you made more than you sold. So you wouldn't deduct all of it. You'd only deduct the part you sold, right? Because it's a product cost. Cost of goods sold is a product cost. You deduct it when the product is sold, not when it's made. And so since you sold less than 100% of what you made, the ending inventory goes up. That means part of that cost is deferred into the next period. Yeah, that's pretty much what you said. Yeah. Yeah. Extended comparison. Now, what happens in year 2? In year 2, they sold 30,000 units, but they only made 25,000. How could you sell more than you made? You had 5,000 left from last year, right? Sitting there in the warehouse, gathering dust, probably getting rained upon or something. And so they sold those. There's a 0 missing here, by the way. That should be 30,000, not 30,00. It should be 30,000. So they every year they make 25,000. First year they sold 20,000. Second year they sold 30,000. The reason they're able to sell 30,000 is because they had 5,000 left from last year. So they sold all of year 2's production, 25,000 units, plus an additional 5,000 that they produced in year 1. And so the units in the beginning inventory were 5,000. The units sales price was 30, and so that's 150,000, which is what we have right there, right? And the unit variable cost then 10, just like before. Selling and administrative expenses 3. The fixed costs remain the same, 150,000 for manufacturing and 100,000 for selling and administrative. Where does that show up? Selling and administrative? Is that a product cost or a period cost? Period cost. You deduct it at the end of the period. Would that be the case under both absorption and variable costing? This 100,000, would that be deducted at the end of the period, regardless of whether you use absorption or variable costing?
I think so.
Yeah, it would be because it's a period cost. Yeah, the only thing that would be different is the treatment of the manufacturing portion of the fixed cost. Unit cost computation, same as before. Under variable costing, it's 10. Absorption costing is 16. Again, 150,000 divided by 25,000 units, the $6 unit cost. Since the variable cost per unit, total fixed cost, and the number of units produced remained unchanged, the unit cost computation also remains unchanged. That's not always the case, but it is in this case. Make it easy. So here's what net operating income would look like. Again, the variable component of manufacturing overhead, $10 here. And again, all fixed manufacturing overhead is expense. So you deduct the whole 150,000 there, which gives you net operating income here of 260,000 under variable costing. What do you think it would be under absorption costing? If it's 260,000 under variable costing, what do you think it would be under absorption costing? Last year was 30,000 more. Is it going to be 30,000 more this year? 30,000 less. 230? Oh, there's that 230 again. What time is it when it's 2:30? Time to go to the dentist. Remember that? 2:30. Okay, every time I see 2:30, it's
Oh, 2:30.
2:30.
2:30.
2:30. Yeah.
2:30.
Yeah, yeah. There we go. 2:30. There it is. Yeah, 30,000 less. In year one, it was 30,000 more, 120 instead of 90. Now instead of being 260, it's 2:30. 2:30. Time to go to the dentist. Okay. In honor of my mother, who told me that joke 100 years ago. Okay, so the fixed manufacturing overhead released from inventory, 5,000 units times $6 unit fixed cost, 30,000. So it's the same 30,000. It's just now it's going in the opposite direction because the ending inventory is less than the beginning inventory. You sold everything you made in the second year plus 5,000 that you made in the first year. 5,000 units, that is. Questions? I'm seeing a few puzzled faces. No? Okay. Again, comparing the two methods, what I just said basically, there's a $30,000 difference. Variable costing net income was 260,000. Under absorption costing, it's 30,000 less because you're taking that 30,000 that was stored in last year's inventory and you're subtracting it in year two because you sold 30,000 units and you only made 25,000. Again, there's where the $6 came from. Manufacturing overhead, 150,000 divided by 25,000 units, $6 per unit. Problems develop when the level of production changes. You know, if this were 28,000 units or 22,000 units or something, this wouldn't be 6, it would be something else. So for purposes of chapter 5, the level of production remains 25,000 units each time. But in the real world, that doesn't happen, right? The different production levels each year. So this is the simplified version. Again, comparing the two methods, if you look at the total under absorption costing years 1 and 2, 120 and 230, 350, variable 90 and 260, 350. Over the long run, it turns out to be the same total for a number of years. The only difference is in which year does the income fall. But over the long run, you're going to get the same exact number, 350 and 350. It just depends on, does the inventory level go up or down? Which brings me to another interesting point. You notice there's a lot of interesting points here? Or am I the only one who thinks they're interesting? I don't know. If you wanted to manipulate income, how would you do that? What would you do to your inventory?
You want to manipulate the income?
Yeah, is there a way to manipulate income here? I'm not advising this, folks. I'm just saying if you wanted to manipulate income, how would you do it?
If you wanted like a higher income from one period versus the other,
Yeah.
like growth products.
Well, yeah, you could make a lot of inventory toward the end of the year, and a lot of those overhead costs would be absorbed into the inventory, and they wouldn't be deducted in arriving at cost of goods sold. Are you saying you could artificially inflate your bottom line by cranking out a lot of inventory in the fourth quarter?
Yeah.
Yes. Should you do that? Well, does your bonus depend on the bottom line? You see the conflict here, right? There's in principal agent theory, have you ever heard of that? Maybe you've taken a business law course. Principal agent, the principal that ends in AL, Principal. That's like the boss kind of thing. The agent is the person who works for the boss. Employees work for the company. You're supposed to do what's in the best interest of the company. But if your bonus depends on a percent of the bottom line, you might do things that benefit you at the expense of the company. I mean, what's the big deal if you crank out an extra 20,000 units in the fourth quarter? It's going to help the bottom line. You're going to have to hire more warehouse space, more people to guard it. You're going to have to pay higher personal property tax, more insurance. And the boss is going to have to pay you a higher bonus. And then you get your contract renewed for another 3 to 5 years. And when it hits the fan next year, because all that stuff's going to be part of cost of goods sold next year, your bottom line is going to be devastated, but you just got a new 5-year contract.
Do you
So-
people in businesses do that in the stock market?
Oh, yeah. No, I shouldn't laugh about it. It's serious. But yeah, this is, this is a way to adjust earnings, not only to benefit yourself, but to benefit stock price. We might as well bring this into it, right? How is stock price determined? Well, there's a lot of intangible things that go into it. But basically, it's a multiple of the bottom line. So whatever net income is, let's say you multiply net income by 12 and divide by the number of shares outstanding, that should be the stock price. I made up to 12 just for illustrative purposes. It depends on the industry. It depends on where you are in the business cycle. If it's a steel company, you might multiply it by 5. If it's a high-tech company, you might multiply it by 25. It depends on the industry. If it's a growth industry, it's usually a larger number. You take net income, multiply it by some number, divide that by the number of shares outstanding, and that's what the stock price should be. I mean, I'm oversimplifying it here, but if you want a little equation, that would be the equation to use.
So what is the SEC call it when you get caught with what you talked about?
Well,
Like insider trading.
Well,
Is it a
if
term?
well, insider trading is if you deal in inside information that's not available to the general public.
Right, but what you talking about? What's that
Well,
part?
income manipulation, yeah. If they have to prove intent. Yeah, if they prove intent, then you're in trouble.
Now,
but-
you, the company, or the accountant who did all this?
Well, whoever is responsible for doing it. And
It's
what,
gonna be the company, ultimately?
well,
Because I know a lot of accountants don't go to jail.
yeah,
The principal,
well,
I guess.
what they taught me in law school is when in doubt, sue everybody. Like in the operating room, if the surgeon makes a mistake, you sue everybody who's in the room. Because otherwise they can point to somebody else and say, no, I didn't do it. This one did. No, that one didn't. But if you sue everybody in the room, someone did it. And yeah, when in doubt, sue everybody. That's like law school 101 kind of thing.
Wow.
Yeah. So what these lawyers would do is, is
You're not a fan of lawyers.
I went to law school. they taught me how to do this stuff. They would bring in guest speakers who would tell us what they did for their clients or against somebody else's client. I don't want to go down that road. Maybe after a couple of years, but yeah. So anyway, you sue the company. Just to be on the safe side, you sue whatever CPA firm audited the books for that company because they were supposed to alert the general public and the SEC. And maybe they didn't. Now, maybe they didn't because of negligence. Maybe it's just one of those things because CPA firms are not really supposed to look for fraud. That's changed a little bit as a result of that Sarbanes-Oxley Act. But basically, they're there to see that you checked off all the boxes that should be checked off. You know, did you follow generally accepted accounting principles? If the answer is yes, they give you the stamp of approval. That's basically it. And then they're off the hook because they did their job. They were hired to check off all the boxes that should be checked. And if there were a few boxes that couldn't be checked, they're supposed to notify the Securities and Exchange Commission and the top management, the audit committee, the corporation, and stuff like that. So if there's a class action lawsuit, they'll sue the corporate officers, they'll sue the corporation, they'll sue the CPA firm that audited their books. But if you're doing something like this, where you're manipulating earnings by just beefing up inventory in the fourth quarter, they could just say, well, we thought sales would be higher, and if there's a plausible argument, that would fly.
Yeah, I was thinking like for like quarterly earnings reports, and if companies like missed the target a few times, they would actually be downgraded to like a B or a C.
Mm-hmm.
You know, like but I think I imagine this technique would be harder to do in a quarterly process rather than an annual.
Well, it catches up with you. That's the thing. If you do it in the fourth quarter one year, it's going to hit you in the first quarter of the next year. And so it all, like here, I mean, it averages out. It's going to be 350, 350, you know, regardless of the inventory over the long run. But like John Maynard Keynes, I hate to quote this guy, but he did have a few good quotes. One of them is, in the long run, we're all dead. Like, you know, you need to get your bonus. And so you can manipulate earnings in the fourth quarter in order to get that bonus. I'm not advocating this, folks. I'm just saying, if you wanted to do it, this is one way. Yes?
I'm just curious. So did you study accounting and then did law, or did you study law and then?
I bounce around a bit. Yeah, I have 13 doctorates, so but it started out, I was an accounting major. I loved it the first 2 semesters. First semester of intermediate 2, I said, this is so boring. And I liked my econ classes, so I became an economics major in the second half of my sophomore year. So I took all the econ courses I could. And then I got a job teaching high school algebra for a year and hated it. So I got a job working in a bank. And the guy who interviewed me was an English lit major. He became vice president somehow after 30 years of on-the-job experience. So he said, you've had lots of accounting, haven't you? And I said, yeah, because I thought, well, 3 courses, that was a lot, because it was so boring. So he hired me to be on the audit staff. Never had an auditing class. So what did I do? I went back to night school and I kept my head low below the radar. And I looked at last year's work papers, and I had to make work papers for the current year. So I did the same thing they did last year and hoped that nothing changed. And I got away with it. And I went to night school and took accounting courses, and that's how I became an accountant. And then I was going to law school a few years later after that, because when I worked I was auditing the trust department of the bank. It's one of the things I did. And I noticed all the money these lawyers were making for doing practically nothing. And so I decided to go to law school. I said, I want some of that. And so I went to law school nights.
You take the bar?
Yeah, I'm a member of the New York Bar and a member of the Ohio Society of CPAs.
Why do you say it like that? I mean, you should be.
I'm a member of the New York Bar, and you're not.
Yeah, you earned it. I mean,
Yeah, I understand.
Isn't your opportunity cost higher as a lawyer than it is as an FSU?
Well, on an hourly basis, I make more here than I would as a tax attorney in Manhattan, which I used to be. I used to be a tax attorney in Manhattan. Yeah, I worked a lot of hours. So, you know, big bucks divided by lots of hours means, you know, but here, sort of big bucks divided by almost nothing.
Is it because of the cost of living over here versus the cost of living over there, or just the salary thing?
Well, I lived in New Jersey, which is like 30% cheaper than Manhattan. Take the bus into Manhattan, I do my thing, and then come home. And, you know, I had to pay New York City tax, New York State tax, New Jersey tax, but there was a sort of offset for New Jersey tax.
That's why I asked, because you said Manhattan. I'm from Manhattan.
Yeah.
So that's why I was like, wait a minute.
And I had my own practice, but I didn't have to pay rent.
Okay.
How about that? Yeah. Well, I got this. There's this one client who hired me for like 3 days a week. And they said, you could use our office, you know, to have meetings with clients, and you can use our secretarial staff. Somebody will answer the phone, blah, blah, blah. So there I was in Midtown Manhattan, as a tax attorney. I had a client who gave me 3 days worth of business and with 1099 income, not as an employee. And then I had this big couple thousand square feet worth of office space in Manhattan that I didn't have to pay for, and staff that I didn't have to pay for. So I could undercut all the big boys, and I did.
So you didn't have a fixed cost?
I had no fixed cost. And in those days, I think bus fare was like $3.40 to Manhattan or something. It's gone up a lot since then. Yeah. And then I had another job, a night job, teaching in the MBA program at Seton Hall University. So I had a full-time night job with Seton Hall. They were paying my health, medical, pension, all that stuff. I was in Manhattan doing the tax attorney thing, charging nice fees, you know, with zero overhead. So I don't know if that answers your question. That answers a few questions you didn't ask, I guess. And it all started because I took a job I wasn't qualified for, a bank auditor, never having had an auditing course. So, yeah, so there we go. Yeah, the same thing with, you know, when I was at Seton Hall, I had the opportunity to take a sabbatical. The sabbatical just means you take a year off, and Seton Hall would pay me 75% of my regular salary. And so I was looking for something to do, and I answered this ad in the Journal of Accountancy. Somebody in Eastern Europe was looking for accountants. And so I applied, and it turned out there was this consulting firm in the suburban Washington, D.C. area. They just landed the accounting reform project in Armenia. And they got the contract first, and then they went out and tried to hire somebody to fulfill the contract. So they hired me. They sent me over there for 13 months. And I didn't know anything about international accounting. I was supposed to help their finance ministry convert the country to international financial reporting standards. In the United States, we don't use international accounting standards. So I got a book and I read it on the plane. And by the time I landed, like 14 hours later or something, I knew more about international accounting than anyone in the finance ministry because they knew nothing. This is before the standards had been translated into Russian. And so I had to hire a team of translators, but someone in Moscow was translating them into Russian already. I hired a team of translators to translate them into Armenian. And in the meantime, when I go to the finance ministry, I had to explain this stuff one paragraph at a time. And so I went through all the standards one paragraph at a time. And there weren't a lot of vocabulary words in either Russian or Armenian, like bookkeeper. For instance, there's no Armenian word for bookkeeper. There's no Russian word for bookkeeper. They use the German word. I mean, not for bookkeeper, but for accountant. There's no Russian word for accountant. They use the German word for bookkeeper, Buchhalter. And so I had this team of translators, and they didn't know how to translate the stuff. What's this mean? What's this mean? So that was another little thing I did. But in the meantime, I would keep one chapter ahead of the guys in the finance ministry. And the guy I was coordinating with, he was like a third-tier guy. He was a civil engineer, never had an accounting class. The guy who was a translator was an Armenian guy who got a master's at University of Denver. He knew English really well. He had one undergraduate accounting course, and he was my translator. So there I go again. I took a job I wasn't qualified for. I got on the plane, read the book.
And then somewhere in there you got 197 Taekwondo black belts.
Well, yeah, somewhere along the line I got 197 gold medals in Taekwondo, karate, and Kung Fu tournaments. Yeah. That's another chapter. And Hall of Fame. And world champ. but I don't want to gloat, or maybe a little. So, I mean, the thing is, you know, if you get an opportunity and you're not qualified for it, take the opportunity and learn the stuff later. I mean, very, very soon.
How are they sitting today? How's Armenia sitting today as far as their finance, ministry of finance?
Well, they adopted the rules, but the people on the ground haven't necessarily applied them. Now, if you're a publicly traded company, that's when it really counts. Because if you're in Armenia, where are you going to get money from? The international capital markets, right? Like New York, London, you know, Frankfurt or something. How are you going to get their money? With Armenian financial statements? No, it has to be either US GAAP or the world now is turning to international standards. So if you want to get international capital, you really need to have international standards, you know, in your financial statements. So there are people who know how to do that. I also had to teach all the professors in Armenia, all the ones who were interested anyway, about the international standards so they could teach it to their classes. So part of my job was to reform the accounting curriculum at all the universities in Armenia. of which there were like 6 or something. So I had these 12 or 15 professors who would teach this stuff, but they didn't know the terminology either. They didn't know the difference between a fixed and variable cost. How about that? They had PhDs in economics, because they didn't really have PhDs in accounting over there. But yeah, so you, right here in this room, know more about accounting than some PhDs in Armenia. It wasn't just Armenia, because I did the same thing in Bosnia and they didn't know either. So the Armenian thing was sort of successful, so they sent me to Bosnia. Not as a punishment.
Kind of seems like it.
Well, Bosnia is really a nice country. I mean, after the war. But, yeah. Well, that's okay. So I don't know. Maybe that's more interesting than what I'm doing here.
Anything is more interesting.
Yeah. Well, how did you get me on this topic anyway?
One
Oh.
question, which came first?
You're the one.
Yeah, 2 days.
Yeah, you're the one. What did I do first, accounting or law? I did accounting, and then when I saw I could make more money for doing less work, I decided to go to law school. Yeah. And okay. So I represented clients in tax court and stuff. That was fun. Oh, the stories I could tell, but I'm being recorded. So none of my clients ever went to jail. How about that? Because the ones that were bad, I dumped. It's supposed to be funny, folks, but if I have to tell you it's a joke, it's not a joke. Okay, so anyway, getting back to the really exciting stuff, the summary of key insights, there's only 3 ways this could go. You're comparing the bottom line under absorption costing versus variable. Net income is either going to be higher under variable or higher under absorption, or it's going to be the same. Those are the only 3 options. So this sort of summarizes those 3 options. If the units produced equal the units sold, then there's no effect on inventory, there's no change. Because the ending inventory is the same as the beginning inventory. If the ending inventory is higher, then there's going to be more cost in the ending inventory, less cost in cost of goods sold. And so the relationship between variable and absorption income is going to be the same. Absorption income is going to be equal to variable income. If the units produced are greater than the units sold, like they were in this example, year 1, they produced 25,000 units, they only sold 20,000 units, then inventory increases because it went from 0 units to 5,000 units. So the income under absorption costing is going to be higher, greater than income under variable. That's because in our example, 5,000 of the 25,000 units, 20% of that fixed manufacturing overhead is sitting there in the warehouse in the ending inventory. It's not getting deducted as part of cost of goods sold. So there's going to be more left because you're deducting less. So income under absorption costing is going to be greater than income under variable costing. And the third scenario is units produced are less than units sold. That was in year 2 of our example. They produced 25,000 units in year 2. They sold 30,000 units. So that would be the other case, the year 2 case. So inventory decreases, went from 5,000 units to 0 units. So in that case, absorption costing would give you net income that's less than variable costing, because not only are they deducting 100% of this year's fixed manufacturing overhead, they're deducting 20% of last year's fixed manufacturing overhead as well. Yeah, it's a nice little chart because, and this example goes with it perfectly, the 25,000 that they produced and the 20 or 30,000 that they
I think
sold.
for visual learners, it would help if on this chart, they had that example.
This?
Yeah.
Yeah.
So it's like the numbers underneath it.
Yeah. Yeah, if I were the one doing these slides, I would have a few more numbers in there. Whatever I would put up on the board, I would put up on a slide somewhere. So in the old days, when we used chalk, I could do different stuff, you know. They did have, somebody took it or stole it. There's a thing in here, a whiteboard thing where you can write on and stuff. But when I do that, I have to turn off the screen, and then sometimes it gets disconnected because I tried it a few times. Technology is both good and bad. So, enabling cost volume profit analysis, CVP, cost volume profit. This break-even points gains, losses, stuff like that. Variable costing categorizes cost as fixed and variable, so it is much easier to use this income statement format for cost volume profit analysis. Because absorption costing assigns fixed manufacturing overhead cost to units produced, $6 per unit for Harvey Company, a portion of fixed manufacturing overhead resides in inventory when units remain unsold, which is what we said. Some of it's sitting there in the warehouse as part of ending inventory. The potential result is positive operating income when the number of units sold is less than the break-even point. Can that be possible? Well, in one of the examples in the book, that's exactly what happened, right? Remember that? Yeah. So even if you're below the break-even point, you can make money once until you run out of inventory. Explaining changes in net operating income. Variable costing income is only affected by changes in unit sales, as we saw. It's not affected by the number of units produced. As a general rule, when sales go up, net operating income goes up and vice versa. Well, yeah, usually. Absorption costing income is influenced by changes in unit sales and units of production. Net operating income can be increased simply by producing more units, even if those units are not sold. What? Let me read that again. Net operating income can be increased simply by producing more units, even if those units are not sold. Isn't that what I told you before? If you want to increase the bottom line, you just produce a lot of stuff in the fourth quarter, and if you don't sell it, that's fine. Sitting there in the ending inventory. And so there's less of a deduction against cost of goods sold, which means the bottom line is higher. And that increases the stock price if, anyone want to finish that sentence?
Sorry, I was writing what? Increases what?
When you do this, when you produce a lot of product in the fourth quarter but you don't sell it, net income goes up and stock price also goes up if, and then I ask someone to complete the sentence.
It depends goes high. It depends on that product.
If the following.
Well, the thing is, in economics, they have this thing called the efficient market hypothesis. Have you heard of that?
No.
The efficient market hypothesis says it doesn't matter what you do to the books because somebody's going to see through that and they're going to adjust the stock price accordingly. In other words, all this information floating around there in the marketplace, prices fluctuate based on that information. Nobody has all the information, but collectively, some people say the stock is worth a lot, so they pay a lot. Some people think it's worth a little, so they pay a little. And with all those people bidding for the stock, the price that it actually sells for is pretty close to the correct price. The efficient market hypothesis basically said it all comes out in the wash. Doesn't matter what you do to the books. The stock price is going to reflect the true value of the company because the analysts who look at these financial statements are going to tell their clients to buy or sell, and that's going to have an effect on the stock price. So the stock price is going to be correct regardless of what you do to the books, as long as you don't fail to disclose the information. As long as you have adequate disclosure. Full disclosure is a term they like to use, but adequate's okay. Adequate disclosure. The stock price is going to reflect what the company's actually worth.
So how would you complete that sentence?
Oh, yeah. What was that sentence? Yeah. If you produce a lot of stuff in the fourth quarter that you don't sell, the bottom line, net income is going to go up, and the stock price is going to go up if, and that's the sentence you should complete, if the people who are looking at the financial statements don't realize that you're sort of, this is one way of what they call cooking the books.
Okay.
You've heard that term, cooking the books? Yeah, there are legal and illegal ways to do that. It has a bad name. You think that cooking the books is always illegal. Not always so. Just like you think insider trading is always illegal, it's not all illegal. In fact, the Securities and Exchange Commission has a form that you fill out. If you're one of the legal people who deals in insider trading, you have a certain number of days to file this report with the Securities and Exchange Commission. There are legal ways to benefit from insider trading and illegal ways. Now, Martha Stewart, you've heard of her? Yes. Yeah, she went to jail, but it wasn't for insider trading. It was because she lied to the feds.
Yeah, I was going to say, she didn't.
Yeah, she didn't actually do anything that would make her guilty. There's there's two kinds of people, the kind of people who can deal in inside information and the kind who can't. She was in the category of people who could deal in inside information because she got the information from her boyfriend. Her boyfriend could not trade on inside information because he was part of that other group. She could, and she did, and she just lied to the feds. That's why she went to jail. So basically, the feds can lie to us, but we can't lie to the feds, is the bottom line there. No, the feds don't ever lie to us, do they? No, that's a whole nother story completely. Yeah. So anyway,
I think that's the boyfriend part.
oh yeah, 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 oh, he's a friend, all right.
There's a friend in there. The boyfriend.
There's a
Or I
friend,
just did a paper on it.
yeah, a friend who's a boy, and well, he's like a 70-year-old boy, but yeah. Same thing with you. What do you do if you're on an elevator and you hear about inside information? Can you trade on that without getting arrested? Yeah, probably, because you're not in that class of people who are restricted. Is it ethical to do that? Well, that's up to you. I'm not going to tell you the answer to that one. Reasonable people could disagree on that too. I mean, economists have done studies. Have you heard of utilitarian economics or utilitarian ethics? Yeah, yeah. According to utilitarian ethics, if the majority benefit, it's okay to do it. And economists have measured the effects of, if people deal with insider trading, the stock price corrects faster. If the stock price should be going up, it goes up faster to where it should be. Or if the stock price should be going down, if people trade on it using inside information, the stock adjusts to the correct price faster than would be the case in the absence of insider trading. Causes the market to work more efficiently. There are more winners than losers when that happens. So the logical conclusion is insider trading should be allowed because there are more winners than losers. And several economists, starting with Henry Manny in 1966, he wrote a whole book on it, his doctoral thesis about insider trading, where he applied economic analysis to it. And in most cases, not all cases, the majority benefits by insider trading. Therefore, it meets the utilitarian ethics test, and it should be allowed. How about that? You don't hear that on the 6 o'clock news, right? But if you apply cold, hard economic analysis, there are more winners than losers, usually. Okay, but that takes us a little far afield. That's what I get from reading too many books.
It just like blows my mind that company, like people, okay, obviously if a company tanks out of nowhere and they see that 200 people sold thousands and thousands of stocks right beforehand, they just don't think the SEC is going to audit that. Like, it blows my mind.
Oh, yeah. Well, there are these predatory lawyers in the high-tech industry. Stock tends to be highly volatile. It goes up, goes down. And there were a group of lawyers, mostly in Manhattan, but not exclusively in Manhattan. They would just look at the blips in the stock price for these high-tech companies. And if there was a blip either up or down, they would automatically sue them for insider trading, class action lawsuit. And these small startup companies can't afford to litigate. And so they would settle out of court for a couple $100,000 each. So if you were a predatory lawyer, you would just do that. These parasites, you go and you put the squeeze on any high-tech company where the stock price either goes up or down. And it always goes up or down. Yeah, I know. I mean, it goes up, it goes down. But if you're a high-tech company, it depends on, if there's the word out on the street that you've discovered something new that you can sell, price is going to go up. And so they just sue, and the other company has to try to prove that they're innocent. And it almost never gets to court because it's cheaper to pay them a couple $100,000 to go away. That's a way to make a living as a lawyer. I didn't do that. Other people have. It got so bad that Congress even had to pass a law saying you can't do that. You have to have more than just a blip on the screen in order to have a lawsuit like that, or else the lawyers could actually get sued for abusing the system. But they didn't do that for 5 or 10 years before they passed that law saying you can't do that anymore. Okay, that's only tangentially related to how did we get on that topic? You guys just trying to make me tell you good stories? Okay. I really would like to get through the materials. Maybe it's not as exciting as lawyers in Manhattan, but okay. So anyway, supporting decision-making. Again, if you know things like break-even points and profit margins, and you know which segments are making money, which segments are losing money, you can make better decisions about what to do, what to make, which division to shut down, things like that. Variable costing correctly identifies the additional variable cost incurred to make one more unit, $10 per unit for Harvey Company. It also emphasizes the impact of total fixed cost on profits. Because absorption costing assigns fixed manufacturing overhead cost to units produced, $6 in this case, it gives the impression that fixed manufacturing overhead is variable with respect to the number of units produced. But as I warned you in Chapter 1 or Chapter 2, it isn't. Fixed cost per unit is a sort of worthless, useless number, except in Chapter 5, when the level of production remains the same. The result can be inappropriate pricing decisions and product discontinuation decisions. We're going to see that in numerous examples.
At the end of the year, would the books be off? Because, you know, like say like you're doing an annual January 1st, December 31st, and on December 31st, right, some of that shared fixed expenses hasn't quite been sold yet and is pushing to January. Would your books be off? Or would you just have to pay a lump sum to cover those fixed?
Well, everything would balance. It's just that there'd be too much in ending inventory and not enough in cost of goods sold. I mean, well, I hesitate to say too much because cost of goods sold would be the correct figure. It's just it was artificially manipulated because you're storing the cost in the ending inventory. Yeah. So sometimes that happens just due to error. You know, if you think sales are going to go up 20% in the fourth quarter, you make more stuff. And if they only went up by 12% instead of 20%, you made too much stuff. So it's sitting there in the warehouse. So if the ending inventory is too high, it could be because you just made a mistake in your projections too. It's not just because they're trying to manipulate earnings to get a bigger bonus. So in fact, doing that doesn't really happen that often. It's sort of exciting when it does because you read about it in the Wall Street Journal. But if that happens, it's usually because of a mistake in sales estimates or something. Segment. There's a couple different ways to look at segments. In financial accounting, they use a little different approach, a little different view. Segment here, could be like a product line or a geographic location or something. Segment is any part or activity of an organization about which a manager seeks cost, revenue, or profit data. Like if you have 43 stores, each store could be a separate segment, or a sales territory. All of North and South Carolina, that could be a sales territory, or a service center. If you have a service center that services 14 different stores or something, they could all be segments. And there are two keys to building segmented income statements. Again, if you have a multinational corporation, you have what they call a consolidated income statement. We just take all the revenues from all the units, you put it together. All the expenses from all the units, you put it together. Revenue minus expense equals the bottom line. You can do that for management accounting purposes too, but you can get a lot of extra information if you split it out by segment. You could have revenue for store 491, expenses for store number 491. So you can see how profitable each of those stores are. And that's all they're talking about here. Contribution format should be used because it separates fixed from variable cost and it enables the calculation of a contribution margin. Each store has its own contribution margin. Within that store, and wouldn't you love to have a discussion with an accountant who works at Walmart? Maybe not. I would. How many products do they sell? They each have their own profit margin. Revenue minus variable cost, profit margin, contribution margin. They all have their own contribution margin. Wouldn't you like to ask that accountant exactly how do you account for that? Yeah, sure you would, right? Maybe if I ask you enough times to make it sound thrilling, you'll say yes. But I'm sure there's some interesting stories there. Traceable fixed costs should be separated from common fixed costs to enable the calculation of a segment margin. Again, traceable fixed costs are costs that you can trace to a particular product or department. And common fixed costs would be like the rent for the building or the president's salary, something like that. You can't really trace them, and you also should not allocate them. Traceable fixed costs arise because of the existence of a particular segment and would disappear over time if the segment itself disappeared. If you get rid of the computer division and you outsource it or something, you don't need a manager for that department. So you can get rid of some fixed costs. You can't get rid of the cost of the rent on the building though, unless you move into a new building. Common fixed costs arise because of the overall operation of the company and would not disappear if any particular segment were eliminated. So you can eliminate the computer division, but you still have the company president, you still have the rent on the building and all that. It's important to realize that the traceable fixed cost of one segment may be a common fixed cost of another statement. And they give you an example here, a landing fee. Every time a plane lands, they have to pay a landing fee to whoever owns the airport. That's traceable to the particular flight, but you can't trace it to first class or economy, whatever. So it may be traceable for one unit, like the flight, but it wouldn't be traceable for the subunits, like first class and stuff. You can allocate it, but that's different, right? Tracing is one thing. Allocating is something else. Allocating means, you know, if it's $3,000 every time you land or whatever it is, it can be allocated to each, or I mean, traced to each flight. You can allocate it among first class and economy based on some ratio, maybe the ratio of the ticket prices for each of those seats. But what do you do with that number? That's the thing, you know. There's basically nothing good you can do with that number. If you use that number, you're going to probably make bad decisions about something. So allocating fixed cost is generally a no-no. That's the general rule. And there's an airplane. Is it taking off or is it landing? Landing, I guess, because it's not pointed up. Maybe, yeah. And segment margins. Each segment could have its own margin. Segment margin, which is computed by subtracting the traceable fixed cost of a segment from its contribution margin, is the best gauge of the long-run profitability of a segment. And again, here we have traceable and common costs. Again, there's a big circle on the X to the common cost. If it's traceable, we have this concept in accounting called responsibility accounting. Maybe you heard about that in your financial accounting class, responsibility accounting. If you can trace a cost to a particular department, you allocate the cost to that department. Like sales commissions, where would that go? To the sales department, because you can trace those costs to the sales department. Those are traceable. A common cost might be rent on the building or the president's salary. You not allocate those. You could, but what would you do with that? Remember that story I gave you about the number of square feet in the trust department of the bank? That'd be a good example here. You can allocate the rent based on square feet or something else, but then people get upset because it looks like they're losing money when in fact they were sort of making money. It's those lawyers with the egos, you know. They like to think that they're profitable when in fact they're losing money, but that's because they had big offices with lots of square feet. So they didn't like that. Here's an example. Weber Inc. has two divisions, computer division and the television division. Let's look more closely at the television division's income statement. You can set it up like this, where you have sales, variable cost of goods sold, other variable costs, total variable costs, contribution margins, whatever's left, traceable fixed costs, and then the rest, whatever's left. I don't know why they have this other little thing there. Is there a way I can get rid of that? Apparently not. All I can do is that. Cost of goods sold consists of the variable manufacturing costs. Fixed and variable costs are listed in separate sections because it's a contribution format. Contribution margin is computed by taking sales minus variable costs. Segment margin is television's contribution to profits. So here they have the two segments. They have a television segment and a computer segment and also a total column. They have sales for each, variable costs for each. Contribution margin. What's the contribution margin percentage for the television division or segment? Contribution margin for the television segment. Yeah, 50%, right? Contribution margins 150,000 divided by sales 300,000, that's 50%. 150 divided by 300, 50%. 120 over 200 is the same as 60 over 100, that would be 60%. Right? Okay. Why did I do that? Just because I couldn't resist? Or maybe those are going to show up on another slide. What do you think? Or maybe even on the same slide. No, I don't see them on this slide. But anyway, this is how you structure it. Sales minus variable cost is contribution margin. Then you have the traceable fixed cost that can be traced to one of these departments. And the division margin is whatever's left. The common fixed costs, you do not divide those by segment. You just put it here under the company as a whole, because you don't want to allocate those. It comes out with a meaningless number, plus you get people upset because it affects their bonuses and things. Common fixed costs in this example, 25,000, leaving you with net operating income of 75. But the point I want to make here is with the common fixed cost, you do not spread that 25 over the various segments. You keep it all here. Like the rent on the building, you could allocate it on the basis of square feet, but then you have things like what happened in the trust department of the bank. You know, you could show that they're actually losing money when they're actually making money. It just makes them upset. And if the manager's salary is based on a percent of the bottom line, you could wipe out that person's bonus by allocating that 25,000. And you know, if you have managers that they're upset, they don't produce as much, the good ones leave, and the bad ones stay because no one else will hire them. You ever notice that? Have you ever worked for a company where people are leaving? Which ones leave first? The ones who have marketable skills or the ones who don't? Marketable skills leave first, right? Yeah. And so negative things can happen if you allocate this 25,000. It does no good to do that, and it has negative repercussions. And at the bottom it says common costs should not be allocated. Traceable fixed cost, yes, but not common costs. As previously mentioned, fixed costs that are traceable to one segment can become common if the company is divided into smaller segments. Just like with the airline landing fees, you don't divide into first class and economy and so forth. So let's see how that works. First of all, we have to look at a guy holding a mechanical pencil or something. And then the traceable fixed costs can become common costs. In this case, Weber's television division is classified into regular and big screen. And regular and big screen are the product lines. So on the income statement, you could have it split like this, and then the television division, big screen, regular, and so forth. You can combine those into one column, like they have here. The television division is the sum of these two, regular and big screen. 200,000 plus 100,000 is 3. Then the variable cost, contribution margins, whatever's left. The traceable fixed costs, 45,000 for regular, 35,000 for big screen, total 80,000. And the product line margin is whatever's left. The common costs do not get allocated. You just keep those under the total division line. So the divisional margin is 60, but the individual margins are 60 and 10. Again, fixed costs that are directly traced, 80 plus 10, or 90. So I keep repeating that over and over again. Nobody's going to ever put common costs under regular and big screen, right? We've gone over it enough, hopefully. Now, somebody could do it in an example just to show you what kind of bad things could happen. Decision making. If you have segmented income statements, what's your break-even point? Well, you really have different break-even points, don't you? If you have 512 different products, then you really have 512 different break-even points. Yeah, one for each, because you have revenue minus variable cost equals contribution margin. How would you find the break-even point that way? If you have the contribution margin, what else do you have to look at? Do you divide something by something else? Do you remember that?
Yeah, that's the fixed cost.
Yeah, fixed cost divided by contribution margin is the break-even point, right? Yeah, and there's two ways to look at the break-even point, in terms of dollars and in terms of units. So fixed cost divided by contribution margin is the break-even point. And you can have one for each product. But overall, like the break-even point for Walmart, how would you do that? Well, you could take the total revenue minus the total contribution margin, right? And then whatever's, the contribution margin is what's left after you subtract variable costs and divide that into the total fixed cost. That would give you a weighted average break-even point. That would be a break-even point in terms of total sales. You know, if Walmart sold 5,000 different products, they have a certain product mix. Maybe 1.3% of their sales could be in one department and 0.002 could be in another one. So they have weighted averages. But if you just take the total numbers, total revenue minus total variable cost equal contribution margin, you take contribution margin divided into fixed cost, that would give you the overall weighted average break-even point. So if the product mix remains the same and sales increase, you can project what the bottom line is going to be based on that weighted average break-even point, or contribution margin. Yes? Contribution margin ratio, I should say. Sometimes I get so excited I can't come up with the words. Yeah. So, what do we have? This is for decision-making purposes. Again, decision-making purposes, common costs go under the total, not under the segments. So you have, in this case, if they increase advertising by $5,000, what's going to happen to sales? They think sales are going to increase by 5%. So you increase sales by 5%. This was 200,000, now it's 210,000, 5% more. This was 100,000, now it's 105,000. So sales goes up by 5%. The variable costs, would they go up at all? Please say yes.
Yes.
Yes. By what percent would they go up? 5%. Yes. If sales goes up by 5%, variable cost goes up by 5%. All other things being equal. That's the economist's escape clause, right? All other things being equal. Because if your projection is off, you can just say, well, all other things were unequal. It's the economist's escape clause. But variable costs go up by 5% too. Sales go up by 5%. Variable costs go up by 5%. Contribution margins, whatever's left. And you have the traceable fixed cost. And here, the additional 5,000 they spent on advertising, that would increase the common cost. Common cost used to be 10, now it's 15. And so what happens to the bottom line? 12,250 here, 65,250, and then when you get done with this, 62,500. It used to be 60,000. Remember that from that other slide? This used to be 60,000. It's now 62,500. And so the question is, should they increase advertising by $5,000? Yes, they should, because the bottom line is larger. So in order to answer those questions, should they do this or that?
Yeah.
You do a little analysis like this. If the bottom line is larger afterwards, then yes, they should do it. Compute company-wide and segment break-even points for a company with traceable fixed costs. Here we have the television and computer divisions. Again, the numbers we're familiar with. Common cost, 25,000, some net operating income. What they have left, 75,000. The company-wide break-even point is computed by dividing the sum of the company's traceable fixed costs and common fixed costs by the company's overall contribution margin ratio. Let's look at that second one first. This one, the contribution margin ratio, 270,000 divided by 500,000. The overall contribution margin ratio, 54%. For each product, they have a different one, but overall, the weighted average is going to be 54%. So you just take the traceable fixed costs and the common fixed costs and divide those by the contribution margin, and that's the break-even point in terms of overall sales. That's the sales target they have to reach in order to break even overall when they have a multi-product company, which is almost all companies. Almost all companies sell more than one product. So that's the level of sales, the sales volume they have to achieve to break even. And you can also compute the break-even point for each individual segment. Here we have two segments. Television, again. Oh, look at this. We already did this calculation. 150 over 300,000. Remember that a few slides ago? 50% there. 120 over 200,000, 60% there. So the break-even point, again, 90,000 divided by 0.5, 180,000. Of course, in a multi-product firm, you have to look at the overall, which is 54%, right? It's not this one plus this one divided by 2. You took 50 plus 60 and divided by 2, you get 55, right? Why is this not 55? Remember it was 54? It's because one is larger than the other, right? The 0.54 from the other slide is because it's a weighted average. But you can take the individual components. If you have 500 products, you can have 500 different profit margins, contribution margin ratios, and so forth, and overall. Which brings me to another interesting question. Here's where I pause to build up the anticipation. Which brings me to another interesting question. I forgot what I was going to ask now. Oh, yes. If, let's say the boss says, let's get rid of the 5 least profitable product lines. Would you just get rid of the 5 that have the lowest contribution margin? Or is that deceptively easy?
Wouldn't you get rid of the one that has the lowest actual profit? Or break-even one?
Well, the lowest break-even point could probably be the one you keep, right? The lowest break-even point, you wouldn't have to sell as many units. Now, the reason I mention this is in a couple chapters, we're going to have some examples that show where you shouldn't do that. You know, like let's say you had, well, if the boss says we're going to get rid of one of these, which one should we get rid of? You might say this one because 0.5 is less than 0.6. But that might not be the correct answer because you have to figure how profitable is it per unit of something that's a constrained thing. But let's say that it takes you 10 minutes to make one of these products and it takes you 4 hours to make one of these. If time is the constraint, taking you 4 hours to get 0.6, that's 0.15 per hour. If it takes you 10 minutes for 0.5, that would be 3.0 here, right? 1/6 of an hour, you multiply it by 6. And so just because one has a higher profit margin, contribution margin ratio, you don't necessarily get rid of the product that has the lowest contribution margin ratio because you have to ask yourself some other questions, like how long does it take you to make one of these things? If it takes you 1 minute to make one and 2 days to make another one, the time is a constraining factor, so you have to figure out which one is more profitable on a per hour basis or a per minute basis. You have to take it to the next level. So just saying that this one is more profitable than that one because 60% is better than 50%, that's deceptively simple. You might arrive at the wrong decision if you do that. You have to look at what other constraints you might have, and time is one that they use in a lot of these examples. Materials might be another one. You know, we're going to run into all that. So I'm trying to whet your appetite here, folks, right? This is a multi-layered kind of course, but we're only into chapter 5 and we're already into some pretty good stuff. Notice the $25,000 of company-wide common fixed costs are excluded from the segment break-even calculations because the common fixed costs are not traceable to segments. We've already gone over that. So yeah, basically common cost you put only in the total column. Omission of costs. Cost assigned to a segment should include all costs attributable to that segment from the company's entire value chain, like R&D, product design, manufacturing, and so forth, all that stuff. Inappropriate methods of allocating costs among segments. Failure to trace costs directly, if you can trace them, but you trace them incorrectly, or inappropriate allocation base. We allocated things by square feet before, right? For like rent, you can allocate the rent by square feet, or maybe cubic feet if it's that kind of business, if you're storing natural gas.
What?
What did he say?
Shots fired. You should probably close the door.
Yeah.
Barricade the door.
I'll be the date.
Shut the. Now's the time to bring it out. I don't have one with me. Something else. Okay, class is over for you in cyberspace. We got a gun warning.
I don't know if that would be it,
I mean, you should probably stay until we get off here doing things close.
Yeah.
Yeah. Okay, class is over, folks. We got a gun on the campus warning here.
Could just be an application, but it could also be an active shooter.
Sure.
No, don't. Until it's safe. I thought about that too.
Another thing that we're talking to doing, make some active shooters come in the window and turn off the lights.
Yeah, that's what I'm gonna,
You know,
yeah. I'm in the process of turning off the computer now.
you may have to look over the.
Yeah, turn up the light.